In today's video, we're going to be talking about my favorite 5 dividend stocks that can literally pay you $2,100 a month or more. And in today's video, I'm going to be explaining exactly which dividend stocks I have in my own personal portfolio. You might want to consider them too and make a lot of passive money while you're at it. Each of these dividend stocks can help you get one step closer to your ultimate goal, which very likely is achieving financial freedom, especially if you're subscribed to this channel. As a little disclaimer, I'm not a financial advisor, so make sure you know your own personal situation and consult a professional if you have to. A dividend is essentially a reward that is paid out to shareholders in exchange for that shareholder's loyalty. Generally speaking, dividends are paid out on a quarterly basis. So that means you're probably going to get dividends 4 times a year. That's not always the case. Some companies, they pay them out semi-annually, so you'll get it twice a year, or annually, in which case you'll get it once a year. And dividends are actually paid out from the profit of a company. The first dividend stock that I'm going to talk about is Walgreens Boots Alliance, or WBA. Walgreens is focused in the consumer staples industry, but more specifically, Walgreens does focus in the pharmaceutical and healthcare industries, and I'm sure most of you have been in a Walgreens before. Walgreens, at least in the United States, has over 8,706 stores, which leads me to my next point. Is Walgreens a stock that could be easily disrupted, especially during a recession? And quite honestly, my answer is no. If you think about it, every person needs some sort of healthcare even during a recession. And chances are, especially if you have an illness or if you need some sort of help medically speaking, you're gonna pay for it because you obviously want to be better or you want your loved ones to be better. And that's why Walgreens, at least in my opinion, is probably not going to go under during a recession. It will probably be a pretty stable and solid company, even if there are other market forces tugging at the company stock. In fact, if you look back to the 2020 COVID-19 recession, which of course focused on healthcare issues and medical issues, Walgreens did not really see a major dip in the stock price itself. It actually remained pretty stable. The dividend yield has actually been pretty stable as well. It hasn't grown too much in the past few years, but it also hasn't gone down. To give you an example, the average dividend yield across pretty much most companies is around 3%, give or take a little. The Walgreens Boots Alliance dividend yield is 5.88% at the time of this video. So that means you're making a lot more money on a pretty stable and good valued stock. If you had 100 shares of WBA, or Walgreens Boots Alliance stock, each stock valued at about $32.67 per share, then that means after 1 year, assuming the 5.88% dividend yield stays the same, you would have about $192.10 in your pocket from just passive dividend income. Let's just briefly talk about the stock. In general, the stock has been pretty stable over the last several years. If you're looking for a growth company, this is probably not the best option for you. Walgreens is a pretty stable company, which of course is good, especially if we're looking in a recession. But if your goal is to grow your portfolio as fast as possible, this might not be the right option. One of the bigger risks with the dividend yield for Walgreens Boots Alliance is probably the profit margin of the company. So in other words, if the profit margin changes or drops, then that means they may have to lower the dividend payout to people like you and me. By the way, if you're wondering where do I get all of my investment information and my know-how, one of the resources that I've used in the past and highly recommend is Seeking Alpha. You can find a link in the description below. Seeking Alpha is one of my favorite platforms. It gives you digestible information, very small tidbits. If you haven't yet, you might want to check out Seeking Alpha. It's a monthly subscription and I use it every single day. The next 2 dividend stocks that I'm going to be talking about, I strictly list them because of the high dividend yield. I'm not trying to send a message that smoking is good because both of them are actually in the tobacco industry. With that small disclaimer said, let's jump into my second favorite dividend stock, and that is Altria with the ticker symbol MO or MO. Altria is a very well-known company in the United States. It manufactures some pretty big staples in the tobacco industry, so that's the sector it's in. And think, Mount Marlboro, for example, or other types of cigarettes, even e-cigarettes. Those are some of the products that Altria has produced in the past. Now, if you're wondering wondering if Altria is recession-proof? The answer is probably, at least it has been in the past couple of decades. So it's been a pretty stable company. It hasn't really seen too many spikes, too many lows. While I don't think Altria will be prone or susceptible to recession risk, I do think another pretty big risk is looming ahead of Altria, and specifically that's regulatory risk. Policies or future lawmakers might impact the profitability of a particular industry, like the tobacco industry. So that's something that I might be a little bit weary of, but again, for the last 200 plus years, it hasn't really been impacted that adversely. One thing to remember is Altria is just present in the United States. It is not present on a global basis. Specifically, laws and policies in the United States would likely impact Altria's profits, and thus their dividends paid out to shareholders like you and me. So speaking of dividends, how does Altria's dividend look like? The dividend yield has been pretty safe. What I mean by that is it has been paid out consistently to people like you and me. In other words, Altria's shareholders. However, I am a little bit bearish on this because I do think that future lawsuits, future policymakers might dampen the amount of money that will be paid out at some point. But there is a high likelihood that this will happen, so I would be a little bit more cautious when it comes to expecting regular dividend payouts. But for right now, it's actually a pretty good dividend payout. In fact, the dividend yield is probably one of the highest yields I've seen at 8.53%, which is extremely high given the high quality of the company and the fairly stable stock itself. So again, the dividend yield is pretty high, and also the dividend has grown remarkably in the past several years. To give you an even better example of how the dividend yield has grown, especially during recessions, let's take a look at the 2008 Great Recession. At the beginning of 2008, Altria's dividend yield offered about 23 cents per share that you own. But since 2008 saw the Great Recession, Altria wanted to reward and keep its shareholders invested in the company's stock. So what did they do? They actually increased the dividend yield from 23 cents to 32 cents per share. And since then, it's just grown rapidly to the point where today, the amount of money you get per share is 94 cents. So that is just a little bit of an idea of how shareholders with Altria have been rewarded, especially during the toughest times out there during great recessions like in 2008. Now let's take a look at the actual historical growth of the stock. If you're looking for a growth stock to really bring up the value of your portfolio, this is probably not the one for you because Altria stock has been fairly stable. The stability of the Altria stock has kept up, especially during recessions. Just keep in mind that the actual dividend yield that's paid out can and certainly will at some point change for Altria stock, and that can be because of the company's profit margins, which will likely be directly impacted by regulatory action like we spoke about earlier. How much money would you be making in dividend income in 1 year if you held 100 shares of Altria stock? At the time of this video, one share was trading for about $44.07, which means if you had 100 shares of Altria stock, you would be paid out $375.92 for a year. For the third dividend stock, which I also mentioned earlier, yes, I'll be looking at another tobacco company. The company is Philip Morris International. Philip Morris and Altria are actually pretty close. The only difference is that Philip Morris is focused on products outside of the US. In my opinion, PM is a pretty stable company, also similar to Altria. It's probably going to be a little bit more difficult to disrupt it, especially in a recession, and the past few recessions have proven that as well. So the track record of the company is pretty stable. Just like Altria, I think the biggest risk to Philip Morris International is very likely regulatory risk, especially in the international markets. I know a lot of lawmakers recently have started cracking down on smoking laws and whatnot, especially in Europe, for example, where and how you can smoke, for instance. Those are some areas that might actually dampen the impact of the dividend payout. But as of right now, the dividend is still one of the top dividends out there given the high quality nature of the company itself. Over the past 5 years, the dividend growth rate has been about 3.55%, which means it has been positive over the last half decade, and currently the dividend yield is at about 5.35%, which is a little bit lower than Altria Group, but it's still higher than the actual average, which is about 3% in dividend yields. Since its inception in 2008, Philip Morris International has actually increased by about 84% in the stock value. How much money would you make with Philip Morris International if you had 100 shares, which at the time of this video were worth $94.89 per share? If that was the case, you would be making about $507.66 in annual passive income given the current dividend yield. Let's jump on to the next dividend paying company in my portfolio, and that's called 3M. It is focused in the industrial products industry, but what does that actually mean? 3M produces things like adhesive tape, consumer electronics, automotive parts, cleaning supplies, and the like. So basically, if you have glue or if you have tape or if you have any type of auto supplies or something like that, cleaning supplies, that is probably generated by 3M. The question here is 3M easy to disrupt during a recession? And I'm sure you already know the answer. It's not that easy to disrupt 3M. It's a pretty stable company. In fact, during the 2020 COVID-19 recession, it really didn't budge the stock. The dividend yield is currently 5.74%, which again is higher than the actual average, which is about 3% in dividend yields. So it's above average, it's a pretty stable company, and it produces goods that consumers will need even during a recession. So far, so good. In fact, the last 5 years, the dividend growth rate has been about 3.36%, which again shows a positive trend and could possibly indicate a positive future trend as well. The growth of the stock has also been pretty positive. In fact, since the recording started in 1993, the stock has increased by 288% since the tracking started in 1993. However, I would say that 3M's stock, compared to other companies out there like Apple and Google and Amazon, for example, and even Tesla, has remained pretty stable. So let's talk money. If you owned 100 shares of 3M stock, at the time of this video, one share was worth $104.54. How much money would you have in your pocket in passive income for the year, given the current dividend yield? You would have just over $600 at $600.06. That probably pays, again, for someone's monthly mortgage or maybe monthly grocery bill or auto insurance or whatnot, and that is passive income. And finally, my friend, we made it to my 5th favorite dividend stock, and that is called AbbVie. AbbVie is a company that is highly concentrated in the biopharmaceutical industry. So as you can imagine, the COVID-19 recession didn't exactly impact it for the worse. Rather, it helped it improve, grow, and produce more profit. As you can imagine, AbbVie focuses specifically on the development and the sale of pharmaceutical products. And you might have even heard of one of its most famous products, which is called Humira. Humira is an injectable biological treatment for rheumatoid arthritis, which is an arthritis type that a lot of people suffer from. And some people spend up to $70,000 a year just to access Humira. So as you can see, especially in the United States, you can make a lot of money through medical drugs. How hard or easy is it to disrupt AbbVie in a recession? It's pretty hard to disrupt AbbVie because people are probably going to pay a lot of money to feel better themselves or have their loved ones feel better, regardless the cost. And unfortunately, in America, medical costs are very, very high. People are willing to pay that, and that's one of the reasons why AbbVie is making so much money and able to pay out the profit and dividends to its shareholders like you and me. While it's very hard to disrupt AbbVie during a recession, I do want to say this. One thing that can absolutely rock and shake AbbVie to its core is the expiration of its patents for its healthcare drugs, specifically the Humira drug. Humira has a $200 billion monopoly over the last roughly 20 years or so. However, the patent for Humira just expired in 2023. It means that other biosimilar companies can produce a drug very similar to Humira, but lower the cost, and are starting to sell that in the market as we are speaking today. What does that mean for Humira and AbbVie in general? It means that the actual profit margin will likely lower because those biosimilar companies are emerging and they're starting to market those products whose patents have just expired. These biosimilar copycat drugs are expected to roll out throughout the 2023 year and beyond. So that's one area that I would probably caution and look into a little bit further before putting all your money, which I would never recommend anyway, into a company that pays a dividend like AbbVie. Let's talk about the dividend yield, which has been very good statistically speaking. In fact, over the last 5 years, AbbVie's dividend yield has increased by about 14.53%. 3%. But you might not want to expect that to be the case for the next several years, especially with the biosimilar copycat drugs rolling out. The current dividend yield is at about 4.27%. So it's not as high as other companies like that we talked about, like Altria or Philip Morris International, but it's still higher than the average dividend yield of about 3%. Over the last 9 years, the dividend yield has grown, and that also includes during recessions. So again, if you're looking for a company that consistently pays out a dividend, especially during volatile market times like during a recession, this company, AbbVie, at least as of right now, has always paid out its dividend consistently. How much money in passive dividend income would you get from AbbVie if you had $138.64 at the time of this video? The answer is you'd make about $591.99 in passive dividend income for the year if the dividend yield were to stay the same. That again is a good amount of passive income that you could literally be making in your sleep. In fact, let's tally up all of the dividend stocks that I just mentioned today. If you owned 100 shares of each of the 5 dividend stocks that I just mentioned, you would be making $2,267.73 in 1 year of just passive dividend income. That could pay a month's worth of mortgage or rent, or you could just reinvest those dividends and let your stocks grow. Knowing how and where to invest your money, knowing how to budget, and knowing how to save all alone can be super intimidating and very scary, especially if you don't have experience in the finance sector yourself. In fact, you might feel like you have absolutely no direction and no guidance to get you to your ultimate goal, which is likely financial freedom. And that is exactly where my private wealth suite community comes into play. In this community, you will have direct access to me. You can talk to me on live calls where I answer your questions. I share wealth building advice that I used myself talking to ultra high net worth clients in the past 7 years as working as a wealth advisor. You can ask questions in the private community channel, and you'll get all of this for less than a monthly Netflix subscription. If you're not ready to jump into my private wealth suite community just yet, then make sure you check out the link below in the description to my newsletter, where I send you bi-weekly tidbits of information to help you on your journey for free. And if you want to learn how to make passive income as early as today, make sure to jump on this video right here where I teach you the basic skills to start making passive income in your sleep.